May 22, 1985. A letter lands in the mailroom at Merrill Lynch. Handwritten, anonymous. Postmarked Caracas, Venezuela. It says 2 of the firm's own brokers have been copying other people's trades. Nobody who touched that envelope knew it would end in a 98-count indictment, a $600 million fine, and the destruction of one of the most powerful firms on Wall Street. But the letter is not the strange part. The strange part is who did not send it. 7 frauds. Nearly a century, hundreds of billions of dollars gone, tens of thousands of people who lost their jobs, their pensions, and everything they had put away. And there is one thing all 7 have in common that almost nobody mentions. And not a single one of them did the fraud end because a regulator caught it. Not one. By the end of this, you will know who actually finds these things. And honestly, that should worry you more than the crimes do. Here is what most people believe about Wall Street. They believe somebody is checking, and somebody is. 2 rings of people, in fact. The inner ring sits inside the building, closest to the money. Internal auditors, comptrollers, the people who keep the books and are supposed to notice when the books start lying. The outer ring stands above the market. Outside auditors paid to certify the numbers are true. Boards. And since 1934, the Securities and Exchange Commission, which can demand documents, force testimony, and shut your business down. Hold that in your head. 2 rings. Because by the end, their records look nothing alike. October 24th, 1929. The market is coming apart. A well-connected broker named Richard Whitney walks onto the floor of the New York Stock Exchange, straight to the post where U.S. Steel is traded, and bids $205 a share for 25,000 shares. He does the same on other stocks. The panic stops. For one afternoon, Richard Whitney is the man who saved Wall Street. Within a few years, he is its president. He was also stealing the entire time. He took more than $1 million from the exchange's gratuity fund. That was the fund set aside for the widows and the children of members who had died. He took $150,000 in bonds from the New York Yacht Club, where he happened to be the treasurer, and $800,000 more out of his own father-in-law's estate. So who caught the president of the New York Stock Exchange? Not the SEC. The SEC was 4 years old, and it had to be told. It was the exchange's own comptroller, the bookkeeper, who in early March 1938 put the proof on his boss's desk. And it only went anywhere because the new president, Charles Gay, refused to bury it. On April 12, 1938, a crowd packed Grand Central Terminal to watch the former president of the New York Stock Exchange walked onto a train in handcuffs, bound for Sing Sing prison. He served 3 years and 4 months. Back then, the club could still police itself because the club was small. Everybody knew everybody. 50 years later, it was not small anymore. Which brings us back to that envelope from Caracas. Merrill Lynch took it seriously. They pulled the 2 brokers' accounts, and the trail led to a bank in the Bahamas called Bank Loy. Merrill handed what they had to the SEC. Banking secrecy laws almost held the line. Almost. Under pressure from American officials, a name came out: Dennis Levine, an investment banker who had been trading on inside information since 1980 in 54 different stocks. And then Levine did what people do when they get caught. He gave them somebody bigger. Ivan Boesky, the most famous arbitrage trader in America. Boesky pleaded guilty in November 1986, paid $100 million, and agreed to wear a wire. Then Boesky gave them Michael Milken, the junk bond king, the most powerful man in corporate finance in the world. In March 1989, Milken was hit with a 98-count indictment alleging schemes worth $1.85 billion. And that was the accusation, not a proven loss. His firm, Drexel, Burnham, Lambert, was charged under RICO. That is the law written for organized crime. Drexel was bankrupt by 1990. Now, credit where it is due. The SEC built this case brilliantly. Boesky and Milken are the greatest hits of that agency's whole history. But look again at how it started. The SEC did not find it. A stranger in Venezuela mailed it in, And to this day, nobody knows who wrote that letter. The next one would not even need a letter. It was sitting in a document anyone with an internet connection could download for free. October 2000. A short seller named Jim Chanos is handed an article about how energy trading companies do their accounting. A short seller makes money when a stock goes down, which makes them the only people on Wall Street who get paid to go hunting for bad news. So, Chanos pulls up Enron's annual report. Not a leak, not a tip. The 10K, a public document, free, sitting on a website. Every analyst covering that stock had the same file. He goes to the footnotes, the small print at the back that almost nobody reads. Two things in there told him the most admired company in America was a fiction. Neither one was hidden. The first, when Enron signed a 20-year contract, it could book the profit it guessed it would earn across those 20 years, immediately, today, as revenue. Think about what that does. Every deal Enron signed made this quarter look better, and whether or not the deal ever earned a single dollar, the company could grow forever on paper just by signing things. The second was simpler and worse. Enron was earning about 7% on the money it put to work. Raising that money was costing it about 7 cents in, 9 cents out. On every dollar, that is not an accounting problem. That is a company losing money on its own business and calling it growth. Chanos started betting against Enron at around $60 a share in November 2000. Then he did the thing that actually mattered. He pointed a journalist at it, Bethany Moo Klein, at Fortune magazine, March 5, 2001. The headline was a question. Is Enron overpriced? Inside the company, somebody else had worked it out too. On August 15, 2001, an executive named Sharon Watkins wrote a memo warning that Enron could implode in a wave of accounting scandals. She sent it to her own chief executive, not to the SEC, not to a newspaper, to the man running the company. The public only saw it when investigators released it much later. Enron filed for bankruptcy on December 2, 2001. The stock went from over $80 in January 2001 to under 70 cents a year after that. At the end of 2000, 62% of the employees' retirement plan was held in Enron shares. It went with the company. Ken Lay, the chairman, had taken $20.7 million out of the business in the first 7 months of that same year. Those footnotes were public the whole time. Being available and being read are not the same thing. Now, this next one almost restores your faith. Almost. Clinton, Mississippi, 2002. An internal auditor named Gene Morse is working through the books at WorldCom, one of the biggest telephone companies on earth. He finds a single entry, $500 million, computer expenses, no invoices, no paperwork, no explanation. He takes it to his boss, Cynthia Cooper, the vice president of internal audit. They start pulling the thread. They ask the finance department what the entry actually is, and they are told it is something called prepaid capacity. Cooper's team had never heard that term. There was a good reason for that. It was not a real thing. Here is what WorldCom was doing, and it is simpler than it sounds. WorldCom rented phone lines from other companies to carry its calls. Renting is a cost, like rent on an apartment. Costs come straight off your profit, but WorldCom wrote those payments down as if it had bought something. Equipment it owned that would last for years. And things you own do not come off this year's profit. Same money out the door, completely different number at the bottom of the page. $3.8 billion moved from one column into the other. Across 4 years, about $11 billion. Cooper's team ran their investigation at night so nobody would notice what they were doing. When the chief financial officer, Scott Sullivan, found out they wanted to audit, he asked them to hold off until after the third quarter. He tracked Cooper down outside the office to lean on her. They went to the board's audit committee anyway. June 20th, 2002. And look at what happened next. The fraud was public within days. The stock fell from $64 to about $1. More than 30,000 people lost their jobs. And the chief executive, Bernie Ebbers, got 25 years in federal prison. Congress passed a new law within weeks. The system worked. 4 people with a spreadsheet working after dark found the biggest accounting fraud in American history. So that was that. Problem solved. Except, while Cynthia Cooper's team was working nights in Mississippi, the largest Ponzi scheme in history was already running. It had been running for at least 10 years, and it had already been reported to the SEC 3 separate times. Everything so far has been a story about frauds being found late. This one is different. This is a fraud that was found early, repeatedly, and nothing happened. And the source for what follows is not a journalist or a critic. It is the SEC's own Inspector General, the agency's internal investigator, writing a report about how his own organization missed Bernie Madoff. Start in 1992, 16 years before the collapse. The SEC was already looking at money that ended up with Madoff. To check whether his trades were real, they needed records from an independent company called the Depository Trust Company, the place where the actual ownership of shares gets recorded. They did ask for those records. They asked Madoff for copies of them. The Inspector General's own words, had they gone to the Depository Trust directly, quote, there is an excellent chance that they would have uncovered Madoff's Ponzi scheme in 1992. 16 years early. One request, to the right building. In May 2000, an investigator named Harry Markop-Ullis handed the SEC's Boston office an 8-page complaint. In October 2005, he submitted a document with a title that leaves very little room for interpretation. The world's largest hedge fund is a fraud. It laid out around 30 red flags. It said a Ponzi scheme was, quote, highly likely. SEC staff themselves described his work as more detailed than the average complaint. The Inspector General later wrote that he could find no explanation for why it was dismissed so quickly. In May 2001, Maher, Hedge, and Barron's both ran articles asking how Madoff's returns could possibly be that smooth. The SEC was aware of both. In 2004 and 2005, the SEC finally examined him. The team was 2 junior examiners with no branch chief assigned to supervise them. They decided not to request the trading data that would have settled the whole question, because in their own words, that data can be tremendously voluminous and difficult to deal with, and takes a ton of time. Then they were pulled off it and reassigned to mutual fund projects. Later, another referral came back with a note attached. We will not be pursuing the allegations in it. Add it all up. Between 1992 and 2008, the SEC received 6 substantive complaints about Bernie Madoff. The report's own footnote admits it was arguably 8. 3 examinations, 2 investigations, and the conclusion written by the agency about itself, quote, a thorough and competent investigation or examination was never performed. At no point in 16 years did the SEC ever verify Madoff's trading with an independent third party. Not once. And then, there is the detail that should stay with you. That same report notes that private firms, ordinary companies doing ordinary homework before putting money in, looked at Madoff and quietly decided he was not safe. They had no power to demand anything. No subpoenas, no badge, they just did the arithmetic and walked away. The organization with all of the power did not, so how did it actually end? In December 2008, Bernie Madoff sat his sons down and told them the business was one big lie. They walked out of the building and called the federal government on their own father. The books showed $64.8 billion that did not exist. The real cash people had handed over came to around $17.5 billion. More than 40,000 investors across 127 countries. He got 150 years. And in that same year, the 4th largest investment bank in America was doing something that would take 2,200 pages to describe. Nobody found that one either. Not while it was still alive. Lehman Brothers had a technique its own people called Repo 105. Here is how it worked. A few days before the end of the quarter, the day a company has to show the world its balance sheet, Lehman would send around $50 billion of securities overseas and take cash for them. Normally, that is a loan. It stays on your books. But Lehman recorded it as a sale. Sold. Gone. Then it used the cash to pay down debt and reported the cleaner numbers to investors. And a few days later, once the photograph had been taken, it bought everything straight back. The bank looked less indebted than it really was on precisely the days anyone was looking. So who found it? Not the SEC, not the auditors who knew about the treatment. It was a court-appointed bankruptcy examiner named Anton Valukas. His report landed on March 11, 2010. 9 volumes, 2,200 pages built out of more than 10 million documents at a cost of about $38 million. Lehman had been dead for 18 months. And this next part matters, so let us be precise about it. Valukas found what the law calls a colorable claim, meaning there is enough credible evidence that a court should look at it, that the sole function of these trades was, in his words, balance sheet manipulation. That is not a conviction. It is not even a charge, because no Lehman Brothers executive was ever criminally charged. Not one, ever. The auditor Ernst & Young settled with the state of New York in April 2015 for $10 million with no admission of wrongdoing. Notice what has changed. In 1938, a bookkeeper caught it. In 2002, an internal auditor caught it. By 2008, you find out from an autopsy. Which brings us to the most recent one, and by now the machinery has slipped one more step. November 2nd, 2022. A reporter at a crypto news site called CoinDesk, Ian Allison, publishes a leaked balance sheet. It belonged to Alameda Research, the trading firm owned by the same man who owned the FTX exchange, Sam Bankman-Fried. The document showed that roughly 40% of Alameda's $14.6 billion in assets was a token called FTT. FTT was not dollars, not bonds. It was a coin FTX had created itself out of nothing and given a value to. They were using their own homework as collateral for the exam. 10 days. That is all it took from that article to bankruptcy. Around $8 billion of customer money was gone. Sam Bankman-Fried was convicted on November 2nd, 2023, 1 year to the day after the article that started it. 25 years in prison, and an $11 billion forfeiture order. And there it is. 84 years after a bookkeeper opened a ledger in 1938, the most sophisticated financial system in human history was still being audited by a journalist with a leaked spreadsheet. So who actually paid for all this? Bernie Ebbers got 25 years. He served 13, was released on compassionate grounds in December 2019, and died about 6 weeks later. Bernie Madoff got 150 years and died in prison. Jeff Skilling of Enron was sentenced to more than 24 years and served 12. Andrew Fastow, the finance chief who built the structures, got 6. Michael Milken was sentenced to 10 years. He served 22 months, and in February 2020, he received a full presidential pardon. Every Lehman Brothers executive never charged, not one. And then there is Arthur Andersen, the accounting firm that signed off on Enron. It was convicted in 2002 of obstructing justice for shredding documents. That conviction destroyed the firm. Around 28,000 people in the United States lost their jobs. In 2005, the Supreme Court threw that conviction out unanimously. The firm was already gone. Nobody handed those jobs back. And here's the part that genuinely surprises people. The money largely came back, but not through the regulators, through lawyers. A court-appointed trustee named Irving Picard has clawed back around $15.3 billion for Madoff's victims, with another $4.3 billion recovered by the Justice Department. Victims have got back roughly 94% of what they actually put in. FTX's estate has now paid most creditor groups more than 100% of their approved claims, although those claims were frozen at November 2022 prices, so the phrase "made whole" is doing a lot of work in that sentence. The system turned out to be very good at cleaning up. It was never very good at looking, and that is the thing worth taking from all 7 of these. Every one of them was visible before it was famous. The footnotes were public, the letter was mailed, the memo was written, the complaint was filed 6 separate times across 16 years. The information was almost never the missing piece. Attention was. Now remember those 2 rings. The inner ring did its job twice. A bookkeeper at the New York Stock Exchange, an internal audit team in Mississippi. Both were paid to catch exactly this, and both did, against their own bosses, at real risk to themselves. That matters. The controls closest to the money genuinely can work. The other 5 were caught by luck. A stranger in Venezuela, an investor who profits from bad news, a journalist, 2 sons, a bankruptcy examiner reading the corpse, a leaked spreadsheet. The outer ring did worse than miss it. Twice, the outside auditor, paid specifically to certify the numbers were true, looked straight at it and signed anyway. And the regulator, with the badge and the subpoena power and every legal advantage there is across all 7, was never the one who got there first. If you found this interesting, you should watch this video too. There is a lot more on this channel about how money actually moves, and once you can see it, you cannot unsee it. And if there was a term in here you would like broken down properly, put it in the comments. If enough people ask about the same one, it becomes its own video.